This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So if you've kept up with financial news lately, you've probably seen a lot of articles and videos around the federal agencies around housing, basically making it more expensive for those with solid credit scores and lowering it for those with subpar or less than favorable credit scores, meaning that if you have a higher credit score, you're paying more finance charges on your mortgage if it's a federally funded loan, or backed loan rather, not funded, but backed. And you're paying less if you have lower credit. This is an overstatement. That's the first point I want to make in this video. That's an overstatement. And if you haven't run across this yet, I want to be the first to clarify. It's been more of a rebalancing situation. Now, what happened is the financing charge that comes with your federally backed mortgage is a little bit more expensive if you are in a prime credit range, in a pretty decent credit range, right? So think 720 to 760. If you are more in the 620 to 660, then there's been a tapering off of the charge. There used to be those who were in the 620 to 660 range were paying about 12 times more on the finance charge, and that's been about cut in half. And those on the other end, it's the same thing if you're at the higher end of the spectrum. That having been said, those with higher credit scores are absolutely still paying less in their interest rates and finance charges than those with subpar credit scores or less than favorable credit scores. I want to clarify that now. That is not the point of this video. This video is actually to point out something that did not get a lot of attention by the media and by the alternative financial space like YouTube, content creators. There wasn't a lot of attention around this, but I want to bring it to your attention because I, as a financial professional and a banker and working in the lending space, excuse me, and the mortgage space, feel like this is important. I see this as important. There's been 2 new brackets added to the credit ratings with the federal backed mortgage loans, meaning that it used to be if you had a 740 or higher, then you were considered prime. And that was like, the highest level credit you can bring and get the best rate. So 740 to 850 were pretty much all the same. What has changed now is you see brackets now, 740 to 760, 760 to 780, and 780 and above. More interesting, 780 with low down payment actually has the best financing options on the entire graph. If you look at the chart on the FHA's website around this, and you'll find it all over the place. I'm not going to probably plug it here. I may plug it in the description. But there's a graph that shows your credit rating, your deposit amount, and then the finance charge. And it goes from the poorest credit, lowest down payment, and it goes all the way through to higher down payment amounts, let's call it from anywhere from 3% or 0% or 3% to 20% or more. And then credit scores, 580 or 620 to 780 and above. You will see that having a 780 or above and putting less than 10% down was the absolute most favorable financing charge on the entire chart. Why is this important? Well, if you factor in the fact that we have a credit crunch going on, or at least a potential ensuing credit crunch, and now you're starting to see shifts on the federal charts when it comes to the credit ratings in relation to housing, where they're now identifying those with 760s and 780s. Mind you, those in the 740 to 760 range are the ones who are actually seeing the biggest increase on their finance charge. Again, 780 and above are actually in the best spot if they're putting less than 10% down. What I want to point out to you really quickly in this video is you have to prioritize your credit. Unless you're somebody who is rolling in a ton of cash, you have to prioritize your credit. It's getting to the point where There's ultra prime now in credit. There used to be a ceiling at 740, 760. Now the ceiling is 780. It's getting to the point where lenders and the government backing these lenders are looking to take less and less risk. You have to be privy to this in the coming years. The age of dirt cheap, free, easy money is behind us. If you don't have prime credit and a supporting credit report to go with it, you are going to be left behind holding the bag when it comes to higher finance charges and even getting more denials as the economy continues to shift, the banking system continues to shift, and all of these entities are looking to take less risk. You're going to have compensating factors. And one of the most powerful compensating factors you can have is prime credit and a prime credit report to match. I wanted to point this out to you, not to go through a bunch of graphs and charts. If you follow my channel at this point in time, you may be privy that, I think graphics are great. All of that is cool, but I think raw conversation, educated, mature, factual conversation is very important when it comes to finances. I don't need you with coloring sections and pop-up pictures in my videos at this point in time. We'll start to grow into that content where we're looking at more specific things. At the moment, this is for you to this is a warning. This is an awareness thing. You have to start strengthening your credit. I have so much content around building credit from scratch, rebuilding credit, stacking credit up. If you're in a decent spot, how do you get to a higher spot? I have a lot of content out and more is coming on a daily basis. I wanted to bring this to you again to get you to understand that now there's a new prime credit limit or credit rating from the 740 mark to 780. It's a big deal and it's under the radar. And it's an indication. It's one of those things that is under the radar. It's an indication of the psychology of lenders and the government backing these lenders. It's very important that you pay attention to this. I'm taking the time out to bring this content to you as it comes to me and to put perspective on it, because almost nobody covered it in an article with any real attention, and nobody really covered it in any videos that I've come across from other financial YouTubers and content creators. So I'm telling you, as a financial professional, somebody who, again, works in banking, works as a financial professional, works in lending, works with the mortgage loan industry, that the fact that they are making this shift to demand or at least reward higher credit ratings is an indication of where this money is going. Credit is going. It's getting tight. Not for those who have prime credit, not for those who have prime credit, but those of you who fall below. And that 700, 720 mark when it comes to stuff like mortgages is not going to cut it anymore. As far as getting the best terms, it's not going to cut it anymore. So I wanted to bring this to you to keep you on a cutting edge of the shifts that are coming and the changes in psychology, which come out on paper, come out in application, come out in lending terms that we all have to live with. I appreciate y'all for tuning in. Support the channel, like the video, subscribe, stay tuned in for more content. I enjoy bringing you this content. To all my pioneers out there, as always, I want you to stay focused, stay in motion. I'll see y'all soon.